Okay, week 32 outlook number 1. Welcome back, everyone. Again, I hope you all have been learning a lot from these outlooks from the price action perspective that I'm showing you, and I hope you're also enjoying the videos. Like I said before, I don't respond to the comments, but if you feel like dropping a comment, I will mention something about it, most likely in another video or hint at it. Or if you want to actually engage with me, you can join the RCV community where I'm an active member there. So, without further ado, let's get into the price action. For the British pound futures, we have some more developments. So, in last week's outlook, we panned out the three scenarios that were likely to occur. Well, it looks like that scenario number 3 is the one that's playing out right now, where the first two scenarios we said were looking for a pullback into this price gap following the action of mitigation for continuation of sells following this break of structure, or we were looking for scenario number 2. I mix up the scenario numbers, but anyway, the bullish scenario was a pullback into this area of interest to spark bullish price action. Well, we decided to just say forget all that and just go with scenario number 3, which is just yield to the bullish price action or the raw price action that's happening, and we've got something completely different happening. So I'm gonna clear the chart here, this and this, get rid of this, and I guess we could leave this on here just in case, but nonetheless, this is what's happening. So we did end up getting a break of structure, but immediately after the failed continuation of the break of structure, we got multiple levels of structure broken here inside of this price leg, where we have this break of structure, because remember, the break of structure is defined as the body closing above the previous high or liquidity point. So then we cleared all of these highs, and then the most important break of structure of all was the one here, where the price gap that was presented following the action mitigation was invalidated, and this is also a part of a liquidity point. So if this liquidity point broke, then we have break of structure and inclination that we will have continuation of bullish price action. So that is exactly what happened. So we got that bullish break of structure of this liquidity point, too. So this was really like the initial, but this is the confirmation. And then now, because we are looking at the continuation of bullish price action, well, we know that our immediate target should be this high here. Right, that is the last liquidity point that sparked all of this price action. And then we know if we have a breaker structure of this high, then the next liquidity point, or literally the only liquidity point that exists above it, would be these equal highs, and specifically that liquidity point that we had marked out for months now. Okay, so we have this breaker structure, and now what we get into is the price action in the current. What we have following the break of structure is mitigation of inefficient price action. Raw inefficient price action. So it's not a price gap, it's just inefficient price action. And so this mitigation of this inefficient price action spurred the creation of this sponsored candle. And so what we can see is following the sponsored candle creation, we had continuation, or we have impulse higher to continue the bullish price action, and immediately, instead of continuing to draw higher, what we did was we pulled back and mitigated 50% of, or open and 50% of, this 4-hour sponsored candle. And now what we should be looking for, if this candle holds, and this scenario holds, is continuation of bullish price action to aim for the immediate high here, which is a new liquidity point, but then also the main target, which is this liquidity point that created all of this price action moving forward. Now, that is one bullish scenario. The second bullish scenario is we could, because this ended up closing inside of it, which isn't really relevant because we could scan down to the lower time frames and find the entry that price was most likely looking to draw into, because if it's going into a sponsored candle, or if it's going into a price gap, there is a specific point, more likely than not, that price is going to mitigate before it continues with the real move. Backtest it, look at it. If you want to learn more about that, like I said, join RCV and discuss it there. But anyway, the sponsored candle was mitigated. Let's say the sponsored candle is mitigated. Well, the scenario number 2 is we do have now a liquidity point here. We could have a structural action here instead of getting a response from the sponsored candle. So it is highly possible that following this action of mitigation, following the mitigation of the sponsored candle, if the sponsored candle response is invalidated, price can very well have some sort of structural action at the low, which is a liquidity point / structural point of this sponsor candle. And so depending, once we know, as always, depending on the structural action, this could change or shift our structure from bullish to bearish, or it could just be a deep liquidity pool if it's a liquidity draw for continuation of bullish price action. All right, so those are the two bullish scenarios. The bearish scenarios, what we're seeing is, well, actually, I probably should mark that up because we have to take note of both sides of the market, is we do have mitigation of bearish inefficient pricing, which exists from here to here. Let me see, zoom in. So from here to here. So like I said before, this is just inefficient pricing, and effectively we've mitigated 100% of it. But this is just inefficient pricing. So if this is going to hold, what we would need to see actually is most likely invalidation of the sponsor candle, and then also the creation of a price gap for price to mitigate. But we don't have either of those yet. So it's really, really risky in my book to look for sells at this time. We would need to get more confirmation and then an entry opportunity in order to frame up that. So the three scenarios, once again, currently is the mitigation of the bullish sponsor candle, or we have the liquidity draw of this low, and then the bearish scenario would be the creation of some sort of price gap, and then also a break of structure of this low, in which we would look for a pullback, mitigation, and continuation. Because this is an action of mitigation, already all we need is to show the confirmation is the creation of some sort of price gap followed by invalidation of this sponsor candle. All right, so that's a lot of stuff there, a lot of gems right there, I would say, but that is the scenario for GU or 6B1. So moving on to the NASDAQ. Woo! Well, we are definitely inside of a range. We've basically pulled back to equilibrium. We haven't actually touched it, but nonetheless, we are getting a response from that area. It is a very sensitive area, so just right past, really I would say, we can call it like 2% into the premium, 2% into the discount is really the equilibrium of the range. But nonetheless, we're getting a very strong response from around equilibrium of the range, and we're moving higher. So because we are in a range, we have to remember that any pullback into the premium, I'm not going to say we should, it would behoove you, I'll use my big words here, to look for selling opportunities because we are in the premium side of a range and there's a lot of short interest. If we are in the discount side of the range, then we should be looking for buys. Simple as that, right? So because of that, we have the break of structure that solidified the creation of the range. And now what we are looking for on the premium side is the inefficient pricing to balance the premium side of the range. Well, let's look at where we are. Well, we had this inefficient pricing here, but that inefficient pricing here would not be a good entry once again, because what? There's no action of mitigation. And so you can see that even though price responded from this area, it was quickly mitigated or absorbed, and we decided to move higher. Why? Because there's not enough short interest in this area to sustain lower, and that is confirmation or validation of that would have been the action of mitigation to create the price gap. But because this is just raw inefficient pricing, it would be risky to enter there. Now we have mitigation of this inefficient pricing. Well, similar sentiment, right? There is no action of mitigation. You see all of these candles, but there's no action and mitigation of anything over here. There's no inefficient pricing. So even though this has been created, this is just raw inefficient pricing. So if we were wanting to look for sells, we would need to see this mitigated, and then we expand lower, creating a new price gap, and that would be the entry. So obviously, this most likely will fail. Time will tell. All right. And then if we start moving up even higher, what we see is what I pre-marked out is that we do have an action mitigation of this price gap here. Now, some of you might be looking at this and be like, well, Brendan, those wicks look, really close together. That is not together. That is inefficient pricing. And so as we mark it out, the inefficient pricing exists from, here to here. So if we extend that out, we see that we did actually get the action mitigation of this area, and so that spurred the creation of this sponsor candle, and that sponsor candle is what led to all of this. So this should also, if you're building your price action chops here in your eyes, you're getting your vision for it, you can see clearly that this move led to this. And not only did it lead to it, it led to break of structure here and so on and so forth. And so you can see also that price tried to come back up here, which created relatively equal highs because this high is not higher than this high. That's relatively equal highs. So not only do we have basically, what's the word? I'm losing my words here. My goodness, I'm so tired. Basically, what we have is evidence that there was some sort of move that was we failed to reach back to, but we have basically a target or a liquidity pool that could trigger some sort of bias to get back up into this area to mitigate this sponsor candle and then continue with either invalidation of the sponsor candle or validation and drive deeper into the range. So because of that, what we are looking at is for price to continue towards this liquidity point because we have no liquidity points existing from where price is currently up to this point. And then once we reach this liquidity point, the most likely area in which price is going to respond from is where the origin of the move is. And I talk about the origin of the move a lot. Just go back and watch the videos. So because this is the origin of the move, this is the sponsor candle that we are looking for price to play off of. Now, just because I said that's what I'm looking for doesn't mean it's necessarily going to happen. But what I just laid out is the logic or the thesis behind the price action that we are looking for if we are going to look for continuation of sells. Now, that is the selling opportunity. The buying opportunity is followed by the just continuation of price action moving higher, in which there's not really much to look at per se. We do have inefficient pricing here. I mean, there's inefficient pricing here. There's inefficient pricing that got filled here. I mean, we could have some sort of pullback, but we would need to create that. But because we're in the premium side of the range, it's not really optimal or, I guess, standard practice to look for buys. So I'm already kind of like, if I'm picking at straws here if I'm trying to look for buying opportunities inside the premium of this range. So I'm just going to stop there and not confuse anyone. All right, so but that's what we're looking at on NQ. Now, for the Dow Jones, well, the Dow Jones has decided that it most likely will break the invalidated range. It may not actually be the true range that we are looking for. And I mean, yeah, I mean, it just is what it is, right? There's not really much to say here. I haven't done too much analysis on it, but the way that price is looking, we do have a break of structure of this liquidity point that we did mark out. We have these equal highs, and because we have the break of structure of these equal highs, it is fairly possible that, we continue on with the bullish price action. So if that is the case, then this range that we have marked out would actually not be the correct range. It could be an invalid range. And so I have to do a little bit more analysis and detailed analysis on this. But like I said before, I'm not really looking at the Dow Jones per se to trade off of. I'm tracking it, but my focus right now is on the NASDAQ. But for completeness, what we have in the current price action is mitigation of some sort of inefficient pricing. We have a run higher to clear this liquidity point here, which are actually these relatively equal highs. And so something to look at when we're looking at price action, we have very level liquidity here. And that should be, like I said, evidence, and your eyes should be drawn to it, that there is liquidity here, lots of liquidity. And because we shattered that liquidity very easily, it should just be abundantly clear, like the signal should be going off that this is most likely going to continue higher to take out what in this case is the all-time high for the Dow Jones. And if that's the case, then we'll have to wait for more price action to develop in order to look for more buying or selling opportunities. Okay, this was a pretty long one. I hope you guys learned a lot. I put a lot into this one. See you in the next one. Week 32, Outlook number 1. Peace.